costs are there when you're looking at shared ownership. It's very similar to if you were buying on the open market, if I'm being perfectly honest with you. So you'll have the usual solicitor's fees, mortgage survey fees, stamp duty, if your share is over 125,000, but first-time buyers do get a stamp duty relief of up to 300,000, but I'll explain a little bit more on stamp duty shortly. You have mortgage arrangement fees, any removal costs if you're going to be using a removal lorry, something like that. Deposit, which I'll also come on to a little bit later. Insurance, council tax, utility bills, all repair and redecoration costs, unless you're on the new model lease, because there is a repair contribution within the new model lease, and there'll be a service charge as well. So with regards to the new model lease, some people have asked, how do you know if the property is on the new model lease or the standard model lease? Because they do differ. Now, the housing association that you're looking to buy a shared ownership home with, they'll have something called a key information document, which will be called a KID. You'll hear it referred to KID quite a bit, but that would detail what model lease you're on, the kind of, if there's any restrictions, what your responsibilities are, and it will also give you an indication of costs if you were to buy further shares in the property as well, based upon the current value at that point in time. So I would always recommend, and it's a really good thing, if you're looking at a shared ownership home, check the KID document, read through it, and make sure you're quite comfortable with what it outlines. Stamp duty. So here's a little bit of an example for you. It can get, I wouldn't say it's complicated, but there's two ways of doing it. So if you opt to pay stamp duty based on the market value election, that's where you use the total market value of the property to calculate how much you pay. So even if you're only buying a share, if you opt for doing it this way, you don't pay any more stamp duty after this, even if you buy a bigger share in the property later on. The other option, which a lot of people do, is to pay for the stamp duty in stages. So you make your first stamp duty payment based on the share price, and if it's above the stamp duty threshold for residential properties. If the share price is below the threshold, you don't pay stamp duty at that point, but you still have to submit a return. I would always recommend speaking to your solicitors based upon your own circumstances to work out how much your stamp duty would be. So this example here just gives you a very basic breakdown. If you were to buy £140,000, which is a 50% share of a property, you've got the full market value there, and it gives you a breakdown of how much the stamp duty would be. And obviously you've got on there about first-time buyers, you only pay the stamp duty above the £300,000, and then 5% on the remainder up to £500,000. So it can be a little bit complicated to work through, but that's where your solicitors are there. So, you know, if you're looking to buy a property through shared ownership and you want to know how the stamp duty works, do speak to your solicitors and understand it in full so you can see exactly what you'd be liable for.